Hello, and welcome to the Mazars Financial Services chat room. I am Barry Goodman, an audit partner at Mazars in the USA. Today, I am joined by a special guest and a friend of Mazars, Steve Strombelline. Steve is a managing director at Capital Forensics. Capital Forensics is a great company that provides a range of services involving data analysis, expert testimony, litigation support, and regulatory consulting, primarily for the financial service industry clients that includes broker-dealers, banks, insurance companies, and registered investment advisors. There are many topics we could discuss today, but we'll focus mainly on broker-dealers with respect to the 2021 FINRA priorities and SEC registered investment advisors. So Steve, thank you for being here. Thank you for helping us break down this information, and let's jump right into it. Sound good?
Pleasure to be with you. Sure does. Go ahead.
Awesome. All right. So regulatory expectations are certainly a moving target. We all know that. So what's the best way to keep track? And let's start with broker-dealers.
Sure. I mean, I think the obvious is listen to the regulators, in particular at FINRA, the Member Supervision Group. They do a terrific job in terms of providing information to the membership in different formats. And it's very helpful in that regard. Also, the SEC, the Division of Examinations, formerly known as OC, short version now, they call themselves exams. They also put out information in various communiques. And I think a combination of the information that those two regulators are putting out, again, on the security side, we could talk more about the future side another day, that plus their enforcement actions are very valuable. I think we always feel good when we see an enforcement action that's informative and our name's not on it. And I think we have to learn from those, of course.
Yeah, my clients do appreciate that. So based on your intelligence, what are the key areas that broker-dealers probably should be focusing on this year?
Sure. Let's start with FINRA's recent 2021 report on exams and risk monitoring programs, which generally focus on all the areas that they've had concerns with over the past year. And then they also highlight some of the violations that they have found, common violations, if you will. So today, we'll talk generally, but also really focus in on three main areas that I think are important for the audience. So on the priorities letter, there's really 18 regulatory areas that they covered, put up into 4 different categories: firm operations, communications and sales, market integrity, and financial management. So let's just zero down a little bit. In the firm operations pod, if you will, they talk about a number of things like anti-money laundering and books and records, but the one that caught my eye was cybersecurity and technology governance. Now, cyber itself, I do see more of a risk and IT responsibility. I think compliance has certain responsibilities within broker-dealers in terms of communicating what the regulators are looking for and what they're communicating, of course. But when you get down to the nuts and bolts, a lot of that falls in areas outside of compliance. But I think technology governance is an area where compliance does play a very, very important role. So what FINRA has been looking for, what they've seen at other member firms, is questioning about how firms are documenting systems change requests and approvals, what type of testing a firm's doing to perform different type of post-environment implementation reviews. I think with firms, surely in the anti-money laundering space, when they've been implementing a new software process, there's very robust post-implementation reviews that are done, sometimes by third parties. But not as much when you get into market abuse and other types of monitoring and software reports that are provided often by third-party vendors, sometimes in-house programs, and it's either a bandwidth, a budget issue, or priority issue. Firms cannot depend on audit to be looking at this area. Audit will have a very specific audit plan that zeroes in on certain things on a risk basis and may not be doing a complete post-implementation review. So FINRA found that certain firms were lacking in that area. Very important to look at that. Also, it's important that where there were technology problems and there would be remediation, firms were not always tracking them sufficiently, not necessarily categorizing problems based on their business impact. Again, risk-based, very important. And firms sometimes were kind of trying to boil the ocean, do too much, and not really prioritize and risk-based, and in other times not doing enough. So kind of ran the gamut in that respect.
Yeah, stuff is very, very important. The cyber stuff is scary. If you don't take care of that, it could ruin your business. So
No,
the money well spent sometimes.
no, I 100% agree in that regard. And I think some of their exam observations where there was maybe deficiencies in terms of that technology governance led to violations in other areas. So when they saw that there was lack of care related to upgrades and modifications to different technology changes or application changes, if you will, it led to violations in a number of areas, including data integrity concerns, just pure books and records inaccuracies. Confirmations would be one particular area, but also those reporting regimens, which I think there have been violations in that area for what seems like a dozen years, like large option position reporting and OATs and trace and things such as that, where firms for some reason just don't have that locked and loaded as well as they should, and violations are still popping up on FINRA examinations. And then finally, I think they look to some of the order management areas. So when it's involving trading algo malfunctions and the lack of testing in those areas, market access issues, so connectivity with the marketplace, they're finding issues there as well. And then finally, how firms are managing and documenting their change management processes. Is it being prioritized, tested appropriately, approved? And depending on which direction they end up going, or if they choose not to do something for a particular point in time, how they document the rationale. I think one particular area that comes up with a lot of firms is when software providers have system upgrades or software upgrades. Firms sometimes choose not to upgrade at a particular point in time for a variety of reasons. Sometimes very sound business decisions are made to hold off on an upgrade. Other times it's budget and bandwidth, not such good reasons necessarily, but whatever that decision-making process is, it really needs to be assessed and documented appropriately. Another big category was communication and sales of the FINRA report. And they covered, again, a number of areas, communications with the public, naturally. There were some references to variable annuities and the communications and disclosures to clients in that area and those products, because there had been some concerns with variable annuities to a certain extent. But the one I wanted to focus upon was Regulation BI, best interest, and the attendant form CRS. That was obviously the new big rule that came out over the course of the last year that affected financial institutions and with broker dealers. FINRA took a very close look and will continue to take a close look this year as they do examinations. So Reg BI establishes a best interest standard of conduct for broker dealers and associated persons when making recommendations to retail customers. And I emphasize retail customers and how that is defined. Not always a simple topic, not necessarily always consistent with certain other regulations. So it's important to focus on not just the original rule as it was written, but also interpretations that have come out by the regulators since then, SEC in particular, as it is actually an SEC rule. On the Form CRS side, it's a more mechanical requirement, obviously, but it is really the starting point of examinations for the broker-dealer regulation group at FINRA. I don't want to speak for them specifically. I'm not there when they're actually doing their reviews, but what they have said publicly is that Form CRS is something they obviously focus on early on in the planning process. And it's looking at the services that firms are offering, the fees, the costs, and the conflicts of interest. That's such a key area. Sometimes conflicts of interest are perfectly okay as long as they're identified, managed, and disclosed properly. Certain time changes have to be made. So that is very important.
It's interesting. A lot of these things are age-old type of things, but they keep coming up because it's just tough to keep monitoring. You have to have a strong backbone here, a strong controls at the broker dealer, and be on top of your game. You really need.
Absolutely. And sometimes there's a new angle that's opposed to an old situation, right? So the regulators quite often will write rules based on that. Yeah. So final thing on best X, because it is so important. It's what they had found on examinations, that there were concerns, naturally, whether or not there were sufficient policies, procedures, and controls, I'll emphasize controls, in place to assess the recommendations that they're making to retail clients to make sure that the best interest standard was used. and that they were considering the express new elements of care, skill, and cost that are required when making those recommendations, and were there reasonable alternatives considered to those recommendations. So it's okay, you make your recommendation, you document it, it's great. But were other alternatives considered, and if they weren't utilized in terms of the recommendations, again, why not? Just document that. It's not hard to do. You go through that assessment. The good part about the rule, it forces firms to sometimes go the extra yard and look for other alternatives that they may not have looked at otherwise. So I actually like that part of the rule. It's very important. Third big bracket was market integrity. Obviously, the marketplace, the integrity of the marketplace is important naturally, but it's also a key element of what FINRA does for a living. On the regulatory side, consolidated audit trail, we could do a separate seminar on that. It was obviously referenced as firms are doing some work and gearing up in phases on CAT. Market access is very important because of the speed and the proficiency of firms related to market access and electronic trading. But the one I wanted to focus on is best execution. Best execution has always been important for many, many years. I mean, forever, really. I mean, I can think of early in my career.
Always.
Right, we would do best execution reviews as regulators, and so it's evolved, and the markets are different, and the products are different, and so the circumstances have become more intense to a certain degree. Rule 5310 would be the one to focus on, which they do reference. And of course, the key is best execution in consideration of the prevailing market conditions, however you define that. Not a simple concept. It may sound simple, but it's not necessarily. FINRA has made it clear that they expect firms to conduct in the best execution regime a regular and rigorous review of execution quality of customer orders. If the firm is not doing a review on an order by order basis, which would not be the normal way to do it, they want to ensure that firms are identifying material differences in execution quality among the different markets that the securities are trading in, and that it should also reference where they're modifying or should be modifying routing arrangements, or justify why they're not modifying their routing arrangements. And here we're talking about order routing going to different marketplaces. Some of their observations related to, again, conflict of interest do come up again, mostly in order routing decisions. But here the key, which most of us would be aware of, especially if we've read the papers the last few months, is a conflict of interest related to payment for order flow. So where firms are trying to monetize the amount of transactions that they're doing for their clients, it's perfectly legitimate to flow their executions to certain limited number of firms and get paid something for that, a penny a share, a half a penny a share, whatever it may be. A perfectly appropriate and legal concept, which again has been around for over 30 years. But the key is that firms are not getting, I'll use the word lazy, in terms of their executions, to make sure that those executing firms that they're utilizing are giving the best possible execution. FINRA has found that sometimes that hasn't been the case, SEC as well, and there have been enforcement cases.
I like this from the notes that we took to prepare for this meeting. You have written down here: the firms must conduct a regular and rigorous review of execution quality of customer orders. So that's, you can keep that in your mind. The two R's, regular and rigorous. You could probably go a long way.
Yeah, that's right. And how you set that up, some firms will use outside parties to come in with that type of capability to show an independence, if you will. We've done that for numerous clients ourselves, so I've kind of seen it firsthand.
Sure.
And using different types of experiences. But they also like to focus on the actual executions and really getting into not only the analyses that's done, the reviews as you referenced them, what's done, what type of meetings are taking place. Firms have, of course, best execution committees that assess those reviews, but also kind of the interaction between the broker-dealer and the executing firms that they're using, and where what they have found on examinations, getting back to FINRA, is situations where there wouldn't be sufficient price improvement. So even though there is a national best bid and best offer, basically the inside spread based on the marketplace, firms can improve off of that and should be considering price improvements in certain circumstances. It comes out in many areas, including, and this is something, again, they referenced during their examinations, that they considered with even odd lots and fractional shares. It's not limited just to round lots, but there needs to be that type of review as well. And again, key area is if you're getting paid for order flow, perfectly fine. Just make sure you're doing a sufficient enough review. The final area that FINRA focused on was financial management. Again, I think we could do a separate podcast on all the financial responsibility rules and all those issues. Of course, they referenced net capital and such, but I think one that they brought up, which I thought was interesting, was credit risk management. What I find over the last, I'm going to say 5 or 6 years, is the connection between compliance and risk has become much more intense. I think they're really connected at the hip these days. At certain firms, compliance is considered a risk management function and is managed that way. But regardless, I think there needs to be a closer connection to the compliance departments and the various risk management departments as well.
Certainly, they go hand in hand. So that's interesting on FINRA. So let's swing to the SEC. How about the SEC? What are they saying for priorities for 2021?
Sure. And let's talk a little bit about the enforcement actions that SEC's exams group, again, Division of Exams, had published in one of their recent 2021 exam priorities letters. Again, great information. They really make a tremendous effort to get out as much information as possible to the membership. And I think that's important. And again, they're covering RIAs as well as broker-dealers, but on the broker-dealer side, let me just focus on 3 very specifically, which again, we could expand out on that on future podcasts, if you will, but 3 just to focus on that are still in vogue, not necessarily new. One is Reg Show, which is really involving short sales. Again, short sales, perfectly appropriate strategy under certain circumstances. If it gets out of hand and is not managed and firms are not following, or individuals sometimes not following the proper short sale rules, it can really push down the markets and it can be undue downward pressure in the marketplace. Not a good thing. No one likes to see it. But again, short sales is a proper strategy, but they did highlight that they found violations, numerous violations of Reg Show. So an area to take another look at your practices there as well. Also, and again, many violations of regulations also may have a failure to supervise charge attendant to that. And they did find that there were quite a few circumstances with different types of broker-dealers where there was failure to supervise registered representatives who ended up making unsuitable recommendations to their retail clients. Again, a focus on retail clients, depending on the type of broker-dealer. Sometimes the types of supervision that were taking place were found to be deficient. And that's important. Sometimes you have firms that have independent contractors, and the type of supervision is sometimes a little bit more remote. Sometimes you have first-line supervisors who are looking at transactions on behalf of the branch managers, and what's the interaction between those 2 groups is very important. And they did find violations in that area. Again, enforcement actions that were public, so that means it was significant. And the final one, which is similar to what FINRA was finding, but worthy of emphasis and repeating it again, is clearly best execution, especially best execution related to firms that are receiving payment for order flow. There was a large fintech firm not too long ago that there was enforcement action against, which SEC is very quick to reference as a warning, I'll say, to other firms to make sure that they're looking closely at their processes, even if they do some type of review, going back to see if the review was sufficient.
Interesting stuff. Yeah, the order payment for order flow was in a debate probably the last bunch of months with the whole GameStop saga and Citadel buying order flow and all that type of stuff. So it's definitely back in the public eye. So it's interesting about that's the SEC's view, recommendations or observations on broker dealers. So let's swing over to the registered investment advisor side. I mean, what do we have coming out on that side?
Sure, absolutely, Barry. And let's just focus quickly on 4 items where there have been enforcement actions. One is that there have been numerous settled matters related to investment advisors' selection of higher cost mutual fund share classes when a lower cost option was available. back 2 years ago, a couple of years ago, I think it was actually 2018 into 2019, SEC had offered amnesty for a program they called the Share Class Selective Disclosure Initiative, where they basically offered to registered investment advisors to go back and do a review of their activity for a period of time to see where they may have sold the wrong share class of a mutual fund to a client where there was another share class with similar economics but had lower costs. We were involved with many clients, a couple of dozen clients actually, to do that analysis, and it was found quite often that that customers were overcharged. I think the initial pass, which was not the final pass, had a little under 100 firms who had gone for amnesty, and there were findings of over 125 million in overcharges with those combined firms, and there were further passes later on. And very, very important area. What I'm seeing now, and so is SEC through the enforcement actions, certain firms did not take up SEC on their amnesty. So SEC during examinations are finding issues, and now charging firms, and naturally the sanctions are more significant for firms that did not take advantage of the initiative of a few years ago.
Right.
A second.
Interesting.
Yes, very much so. The second one is failure to disclose conflicts of interest. Again, we're talking about registered investment advisors. So getting away from the broker-dealer mentality, the rules on the investment advisor side, somewhat different. And of course, Reg BI does apply there as well. And they have already found different types of issues related to conflicts of interest, where investment advisors have always touted a fiduciary responsibility for many, many years, going beyond what maybe in writing and in regulations broker-dealers previously had to do. So that's where you have that disparity between RIAs and broker-dealers. Another area is firms apparently fraudulently inflating net asset values and performance results of managed funds. So again, it gets a little bit into disclosure of what they're representing to individuals and customers generally, but surely retail individuals. Think about our own personal investing, the information that we get from our advisors.
Right.
Do we understand it all? Is it disclosed simply? Is it sufficient? Right. It's a tough area for sure. And they did find problems in that area that resulted in enforcement actions. And finally, they found violations of the custody rule, which I know your firm is very involved with. And it's an area where, again, you could do a separate session just on the custody rule, but they did find violations there as well.
Interesting. Great feedback from enforcement actions, of course. So what feedback has the SEC provided on their kind of routine exams?
Well, it's very interesting. Again, the exams group, as we like to call them, division of exams, they really to scope out their examinations more, to have them more on a risk assessed basis. They're using new technology and advanced data analytics to prioritize their exam candidates. They're really looking at the data and to make those determinations. A lot of this work was done in their offices, even pre-COVID. You can get a lot of information from the members and the member firms. I call them member firms, but the registered investment advisors, and then do something with that. They do the same work for the broker dealers, but on the advisor side as well. And they have been utilizing the work of another division within the commission, the Division of Economic and Risk Analysis, DERA. And they're really utilizing now predictive modeling and even text-based analytics to really improve their exam process. So it's really taken it to a next level, which is very interesting to see. But I think, again, if they can't look at all the registered investment advisors, there's just too many. So if they can do it on a risk basis, much better off. So on the registered investment advisory side, exams group came up with some results of their exams. They pulled out exam findings from about 40 different RIA exams and looked at a number of different areas. Just a real quick high-level highlight. They looked at the portfolio management processes of RIAs and focused on fees. A lot of what they did do on those examinations really did focus on investment decisions, conflicts of interest, trading allocation decisions, such. But again, a high level of view of cost that were assessed to clients and the fees charged. Sometimes they're independent fees, 12B1 fees, and other types of fees. Very important area. And they did, again, assess the oversight of investment recommendations in the mutual fund space. What share class did they recommend? The wrap fee program. Wrap fees were once the only way to go in managed accounts, and now they're looked at very differently, not always in a positive light. So they were concerned with advisors who didn't adequately assess whether the programs were still in the best interest of their clients, sometimes erroneously charging commissions or misrepresenting certain information with clients. Also,
Right.
rebalancing issues. So quite often there's automated rebalancing that results in short-term redemption fees to clients, and whether that was appropriate or not. And also trade allocations of investment opportunities. And of course, best execution again pops up during these examinations. So
always a goodie.
yeah. If you don't get any other message out of the podcast, I hope you get many messages out of the podcast, but one is take another look at your best execution processes.
Yeah. All right. So let's go beyond what's coming from exams, enforcement actions. What else should the RAs be focusing their attention on?
Oh, sure. Yeah, that's one big area. There's new. The SEC has created a new single marketing rule that actually replaces two very significant rules. One that's been around for 50 years, but cash solicitation rule and the advertising rule are now being combined into this new marketing rule. And the effective date is this May, but the actual compliance date is next November of 2022. But what that really means is you got to start to do some work to assess your own practices internally and see where the new rule would apply to you, the registered investment advisor, and what needs to be done. And then you have some time to implement some of the different requirements. And again, SEC exams this year will make sure that you're recognizing the rule and are starting to get that process in place. It covers a lot. And again, you could do a full seminar or a webinar on this rule, and probably should, but some of the areas involve, standardizing certain parts of the performance presentations, how firms are using third-party ratings and how that's being disclosed in advertisements, for argument's sake. So right now, the short message is, but you do have time, is firms need to really assess where they could have compliance triggers that were not previously present before the new marketing rule was created, and they should start doing an inventory and assessing the rules implications. That's the start.
Interesting. So let's swing back to broker dealers now. So FINRA recently issued a notice on sales charge discounts and waivers. So why is that important now?
Well, it's important because they say it's important, number one.
Don't question FINRA.
That's right. Absolutely. But I think this really gets into a combination of market integrity issues, but now we're talking more in the fund space, but that market is important. And then of course, protecting customers, which is many things, but it's surely pricing and fees. And what FINRA is really elaborating on now is different types of common sales charges, discounts, and waivers for a variety of investment company products. And here they're talking quite a bit about supervisory systems and written supervisory procedures. And again, supervisory procedures are the responsibility of senior management on the first line side. Compliance has a role in helping management develop them and make sure that they're sufficient and reasonably designed. And that is getting emphasized to a certain extent now, involving investment company shares by FINRA. Also prospectus discounts. Firms are sometimes failing to display and identify the information appropriately when certain volume discounts might be appropriate, and fee waivers may be appropriate. I know we've done a lot of work with clients in this area. And again, those are not necessarily new requirements. I can think back to my days as a regulator. Well, that was a big area when we looked at firms that focused on investment company share retail work. But obviously firms are still not getting it completely right. And very important, looking at the thresholds related to that, which is a whole different area with surveillance controls. What I have found that FINRA is focusing on, not just with investment advisors, but also with broker dealers, is the surveillance programs that are in place, whether they're homegrown or third-party software that's being utilized. Our firms testing the parameters that have been set, the calibrations that they've put in place, on some regular basis to make sure that the output, the exception reporting that they're getting is giving them good information. Too many false positives, net false negatives, how they're being related to. Is there a regular review that's being done, and is it being assessed and changed accordingly? So this is something that you're seeing all regulators talk about, not just in the IA space, but also in the broker-dealer space. And again, I've seen it with clients that we've been working on with this parameter testing, something that's become very important. Now, I find certain firms who have the means may have staffs in-house that are doing this on a regular basis.
Right.
But a lot of firms who don't have the bandwidth or the budget on a regular basis to test it, when we talk to them, I find it's something they want to do, but they just have kind of put it off. And unfortunately, sometimes regulators are coming in on exams, find issues, go back, look at the surveillance and say, well, you haven't really taken a look for a number of years. You may have picked it up had you done some type of review. So
Right.
again, it's being picked up. And then the final area is that FINRA is also conducting reviews of firms' systems and procedures as they relate to rights of reinstatement on mutual fund purchases. So RORs is just, you can do an easy, quick check of that, either use a third party or do it yourself internally. But the fact is, it's an area of focus and something that firms have missed over the last few years.
Interesting. So clearly there's a lot of information coming out of the regulators on SEC, FINRA. So what's the best way for a broker dealer and RA to digest all this information? And address the issues responsibly?
Absolutely. There's so many
regularly and rigorously.
Yes, to say that 3 times fast. But yeah. It's so true. And one issue is there's so much out there, and you don't want to necessarily cover too much with a broad brush and miss things. So it's very important to really laser focus in and do a comprehensive review of the regulator's findings and observations and see what really applies to your firm. So prioritize naturally and really incorporate that into your overall risk assessment process. Very important. Once you do that, firms naturally take their risk assessment, create a gap analysis, see where there are issues with their current compliance programs and their supervisory efforts, and then on a risk basis, assess what needs to be done. After that, firms are creating project teams. FINRA suggested when you create a project team, make sure you bring in all the regular groups, kind of the usual suspects, if you will, but they include not just compliance, it's operations, it's supervision, first line supervision, the risk groups, the legal department. And I think at some point, business leadership needs to take a responsibility in a very senior role in that process. They may depend on the infrastructure for guidance and implementation, but they need to take the ultimate responsibility. And then naturally, I think not to push it all on the front office, I think compliance who can interpret the regulations maybe best with the help from their legal cousins can then provide the proper guidance through a variety of means, as they have been for many, many years. And then the appropriate training on some type of regular basis, and the type of training that can be focused in small groups. It can be electronic training, but something that's really giving information with value that the front office and the infrastructure can use to improve their overall offering.
Great. That's interesting. So yeah, sitting down, doing that risk assessment, doing the gap analysis, and putting a plan in place seems easy, but there's just so much. There's so many things that could trip you up. But focus on the things that are most important, I think. Right? I mean, that's what makes
absolutely.
sense.
There's a lot of moving parts. There's a lot of requirements. No lack of regulations in the security space, and you really do need to account for them one way or another as best you can.
Right. It's amazing. Well, I want to thank you for being part of this podcast today and helping us break down this information. Again, I look forward to do other podcasts on specific areas throughout the year. But this is wonderful. So thank you for being here. Thank you for being part of it.
It's been my pleasure. Thanks so much for having me.
And this concludes the Mazars Financial Services Chat Room. I am Barry Goodman. Have a great day until we chat again.